So here's what's happening now. Macro discretionary, they have a long time frame, a more settled will than your run-of-the-mill day traders or momentum traders. And I believe that they have been accumulating along with central banks in this area here. It's not always so easy to see. And in that last month before, that's August, we closed above all three of those wicks. The first day of the next month, new money came back in and bought it, and they bought silver. And so the big money's back. The fresh money that was here, that came in March and April of 24, is coming back now.
Hello, everyone. This is Jordan. Welcome back to the Daily Gold YouTube channel. Thank you so much for tuning in. This is our end of the month monthly recap with Vince Lancy. He is the editor and publisher of The Great Gold Fix on Substack. He's also an adjunct professor of corporate finance at the University of Connecticut. And guys, I am doing this interview on the road. I am enjoying some recreation along the Oregon coast. I don't even have a desk here, so just be mindful of that. Vince, what a month it was for gold and silver, and specifically what an end of the month it was. Incredible closes. Silver closed, I believe, at a 14-month high. That's the key factor. I will throw in there, tied for the third highest monthly close ever. Gold closed the month at a new all-time high. You look at the monthly chart, there were dojis in the previous months. Gold closed well above that, and we are seeing strength so far to start September. How are you, and where do you want to take this first? What's the first point you want to make?
First, I want to comment that. Are you wearing that because we traded 3,500? Was that like part of your planned ensemble?
This is the ensemble for most interviews.
Okay. I know that you had acquired an ensemble for significant levels. Okay. Yeah. So 14-year high close for silver. That's outrageous. And in gold, a monthly high outside of those three candles you were talking about. Let's see if we can put that up. Yeah, there it is. Yeah. So, I'd like to describe that chart because that chart is, I think, relevant to what happened and what is happening right now. There's a pattern that's repeating itself. So what you're looking at there is, in the red rectangle, you're looking at 1, 2, 3, 4, 5 months inside the rectangle, right? So we had the first month, I think that was April, market spikes above the top of the rectangle and then gets rejected soundly. I believe that was institutional selling of the central bank variety, keeping a lid on it. And then and we'll get into why in a second. Then for the next 3 months, the market is essentially a doji going nowhere. Keeps trying it, but keeps failing it. You'll notice that there's really only one of the 3 months the market extends out below the rectangle. So there's definitely a bit of this market that's not going away. And there was some selling. I did talk to some people at banks and producers. There has been producer selling in the market for this time as well. So whether a central bank is selling or not is my opinion, but like the BIS. But the producers definitely were selling during this time frame. Okay, so here's where we are. You and I, we've been through this before. Like it's becoming deja vu, Jordan. Every so often we'll hit a month. Like I think we hit one in December of 23, and we hit one in April of 24. And those months are, you'll come out and you'll open with something like highest monthly close in 6 months, 2 years, 5 years. And they were getting longer and longer. And we were talking about moving averages. And I remember saying to you that, when you have these big monthly closes, and for me, it's like a 12-month moving average, the big macro discretionary funds, these guys who play for 6 months to a year at a time, they get involved on month-end closes, above a moving average, above a new high that stabilized. That was your call, above 2000 when it settled at 2000, above 2009. And so that happened. Last time that happened was in December of 23. And then we got a breakout in March, but then we got the real breakout, the new high in April of that month. Now, of that year. Now I'm bringing that to this. I was frankly petrified that the macro discretionary had their way with us and made their money. And now they're off trading Bitcoin or, who knows, ground pepper or whatever it is they trade. I thought we were done. I actually called for COMEX's death, and that I do think COMEX is dying as a futures exchange, but it's picking up as a physical exchange. But okay, so here's what's happening now. Macro discretionary, they have a long time frame, a more settled will than your run of the mill day traders or momentum traders. And I believe that they have been accumulating along with central banks in this area here. It's not always so easy to see. And in that last month before, that's August, we closed above all three of those wicks. And it is what it is. The first day of the next month, new money came back in and bought it, and they bought silver. And so the big money's back. I mean, we had days of over 20,000 lots of open interest increasing on the buy side. So I think, I don't want to be euphoric because I know that you and I are going to talk about what could go wrong. But it seems to me that the whole thing reeks of the fresh money that was here, that came in March and April of 24, is coming back now.
Yeah, and I would just add in, technically, I think based on the breakout, you have, whether you're looking at spot or futures, you have about $300 of upside from the breakout point. So that's the measured upside target. Gold has another $300 worth of upside to me. Then I would say, okay, I have a question of what it can do at that point, because now it has gone, gold has moved quite a ways without anything more than 11% correction. So I'm looking historically. I think if we throw on $300 to that, I think we're getting pretty close where we're really overbought. And then, I'm not saying we're going to crash down from there, but I think the market could set up for a rest for a while after that upside.
Even after the 4-month consolidation, I'm pushing back because I want to get the reason for your numbers. That's why I'm asking.
Yes, because I know this might seem ridiculous to some people because it doesn't always matter, but we're still so far above the 200-day and even the 150-day moving average. Like I wanted the consolidation to continue for a couple more months, get really close to the 200-day moving average, because historically gold makes a major breakout and then it corrects back down. Basically the 200-day moving average. 6 other times it happened. A couple times it went below it a little bit. 2 times it came within 2% of it. And then after those tests, you had huge moves higher. But this time we didn't get anywhere close to the 200-day moving average. So if we got closer to that, I would be more comfortable saying, okay, this move has potential to really go through 4,000. And even if it does, I could be wrong about it. But even if it does go through 4,000, I think it would be setting up for, at some point next year, it gets into the 4,000s, and then we're correcting 15, 20% at that point.
Right.
So that's just my concern, is that we don't have enough upside here compared to the potential downside correction that's coming whenever this latest breakout move ends.
Okay. So then historically, you're saying that the bigger rallies come after we pull back and touch a 200-day moving average during a consolidation period. And we're not getting that yet, right?
The biggest sustained moves post breakout. So you've already had a big breakout move, then you come back and correct.
Right. You need to get some shorts in the market again. There's no shorts in the market. You don't have that impetus to start to.
And just quickly, that's my concern with gold right now. Is that, okay, all the shorts are now, and that's probably how you come into an interim peak.
Right.
Because all the shorts are coming in, they're saying, oh shit, we're done, we got to cover. Right. Then gold shoots up to 3,900, and it's like, okay, there's no shorts left.
Right.
That removes a lot of support for the market.
So, right. Who's buying the dips? There's no one buying the dip because there's no one short. Yeah, I mean the market. I mean, I can't disagree with that at all. But I think it's safe to say that because we didn't get a $200 pull back to the 200-day moving average, our upside may be capped only by $300. Like that's crazy to say. You know what I mean? Like that's where we are in this market. We have another 10% higher move in this market before a potential 20% move lower. That's kind of what I'm hearing. That kind of makes sense.
Yes, I know it. it might sound ridiculous to some, but I'm looking at the historical moves. I mean, if you look at the early 70s, very similar to where we are at this point, where 1972 gold had the breakout move, and I think it was up a similar amount to where we were up a couple months ago. And then gold corrected for, I believe, about 5 months, 12%. Now, this time we corrected 11% for, what was it, 4 months or a little bit more than 4 months. So if we, even this time we were stronger. But what happened to gold at that point? Okay. After that little correction in gold, it shot higher, much higher, where that if we follow that, that would take us to maybe 4,800, 4,500, something like that. But from there, gold in 73 corrected 28% over 3 or 4 months.
Right.
It still went higher, but it was just so, even at that point, it was so stretched above the moving average for such a long time that and I know we'll get into this because I know this is going to bring up multiple tangents, because this is my larger, I'm pushing back on myself. I'm concerned about the market.
Right.
Yes, depending on what you look at, less so silver and silver stocks, but gold and gold stocks, we're overbought. Yeah, we can go up more as we're talking about here. But yes, technically we're too stretched. We need a bigger correction at some point. But even saying that, pros, not just retail, pros are underexposed. They need to come in and buy more. And that's what happened in April. Like April, we were at an interim peak. You know, the breadth indicators for the miners were there. Gold was really extended. We were at an interim peak. But what happened? Because so much money was coming in the sector, gold made a super bullish consolidation, barely corrected. And the gold stocks did a bullish running correction. Like they barely corrected. They were trading at new highs during the last few months. So I know I'm rambling on here, but that's the real interesting factor to me is, yes, the market should, at some point it will correct more, but retail nowhere to be found. Pros are super underexposed, so they need to get more exposure. So and that happened in recent months. That's why gold did not come closer to the 200-day moving average. That's why it was consolidating super bullishly.
And the bullion banks were covering shorts into that too. I mean, the whole market was changing. So maybe the bullion banks are in a better place. And it sounds like you're saying it's okay to bet on another 10% higher, but don't be surprised if we go 20% lower. If we get the 10% higher, be aware. That's all. At 3,700, don't. Yeah, 3,800. Don't necessarily believe 4,000 has to happen before the end of the year.
I think if we shoot above 4,000 convincingly, then I think that would set up for a 20% correction. But if, like, let's say we kind of peak out at 38 or 3,900, only the $300, then I'd have to take a better look at the chart. But then at that point, I don't know, maybe you could correct 15% or 16% and you do a bullish consolidation for 4 or 5 months again.
Right. Another stair step. You know what I'm thinking about your 10%, 20% thing. And just, I like to blend these with other disciplines. So I think that we're rallying on no material news now. Now there's news, there's complete uncertainty, but we're thinking about the news after the fact. Oh, the BRICS this, the BRICS that. No, it's not about the BRICS. Oh, the Russian war. No, we've had the war for 3 years, it's this, it's that. No, it's just going up. And so I believe that when a market goes up without news, we want to be aware of whatever that news is that hasn't come out yet. Someone going on a gold, I mean, I'm making these up, right? You got to think of all these out. Someone goes on a gold standard, the BRICS launch a currency, the US does a gold-backed bond, all these kind of fiscal, governmental things. When that news event happens, if there is a news event like that, and the market rallies on it, that could be your spike high before your interim sell-off. I'm just saying, without news, I'm not selling the rally.
Rate cuts. Yeah, no, I totally agree. But rate cuts, is that
no, that's,
I mean, is the Fed going to cut in a couple weeks, or, I mean, because that could.
No, that's huge. In fact, let's talk about that. And the gold standard, the gold bonds, and all these other things that we talk about, just to hope for and wish for.
Yeah.
The Fed rate cuts are very real. Fed rate cut potential is very real, and it's extremely current events. And if you have a minute, I think we should talk about that, because that could be your Waterloo moment for gold, at least for your 10% correction. You want to talk about that for a sec?
Well, I'd like you to talk about what you see, because for me, from a technical side, I'm looking at, as I've been saying, yes, gold is broken out, has $300 upside, but what could be something that
A news
make
event.
a news event, as you were saying, thank you,
Yeah.
that from
Right.
a contrary perspective
Buy the
leads to
rumor, sell the news.
leads to an interim peak. And so, yeah, that would be my thought. Are we front running? Are we front running the
Okay.
rate cuts? Are miners front running the rate cuts?
Right. Well, miners are different, but I want to stay on the futures, because that's my
Right,
yeah,
yes.
focus. That's right. I mean, but I think the miners were a completely different animal, and I think gold is now catching up to the miners. Meaning, I don't think miners are undervalued. At least the marketplace doesn't think that. Okay, let me just stay on this. All right, so I'm gonna. This is all right. So the bullet point is, the AI bullet point is, I just did a report on this. Okay, or just did an analysis of a report on this. The market is currently discounting an almost 100% chance of a 25-point basis cut. The market is thinking that a 50 basis point cut may be on the table as well. The criteria for a 50 basis point cut is the following, more or less, but you want to see these two things happen in degrees. One is the non-farm payrolls number is slated to come in about 75,000. That's the consensus. If it's under 75,000, that puts 50 basis points on the table. Let's assume that it will be under. Okay. And that's on the 5th. Today's the 3rd. But that doesn't solidify the cut. Then you have CPI on the 11th and PPI. Those everyone's going to talk about in the mainstream media, but we don't care about those right now. Powell has already caved to 2% inflation to be 3%. He did that at Jackson Hole. He said, the mandate is about jobs now. It's not about inflation. I can't worry about it. That's what he said. What really matters, and could be the surprise that gives us the news item, that gives us the 50 basis point cut, is the following. Last month, the BLS revised old jobs numbers significantly lower. This month, so your calendar's up here, September 5th, payrolls come out. September 11th, CPI comes out. In between September 9th, the BLS revises more old payroll numbers. So all those payroll numbers that were high, that everyone was saying, Zero Hedge was saying, these are wrong, they're wrong, they're wrong. Well, they are wrong. They are wrong. And we can get into the math of it some other time, but they are wrong. And now some, I think, sharp people are saying that the odds, Lord's last month's revision in jobs lower, oh, we were too high. You may say, oh, that's just random. Yeah, and sometimes it is just random, but not now. It's not random now, because this system they use for estimating jobs is like a really slow moving average. And so the economy turns, and this thing's going to keep adding jobs for the next 2 months. It's not numbers, it's an estimate. So the economy's down, the numbers go up, the real numbers come in, they revise them lower 2 months later. That's where we are now. So to paint the picture, revisions come in super low. Let's go with the extremes. Revisions come in, jobs are really low. The non-farm payrolls come out, they're a little bit low, and 50 basis points is on the table. On top of that, this is something else that people aren't talking about, but people on the bond market are. You'll notice the bond yields, some people have noticed the bond yields have been going a lot higher, not just here. If you were to pull up anytime you want a Japanese yield, bond yield with gold, you would see that they're doing the same exact thing right now. The whole world is selling bonds and parking it in gold. And hear me out. They're doing it for multiple reasons, but the reason they're doing it right now is the marketplace is drying up for liquidity. So they think the bond market's going to continue to sell off until the Fed cuts, and then we'll have inflation, but that's another conversation altogether. The point is, if Powell cuts 50 basis points, that could be your spike and slam, right? If he cuts 25 basis points, we could rally and go sideways. If he doesn't cut at all, then we probably could go to zero. I mean, I'm exaggerating. You get my point. But there's a scenario. We're talking about all these other things. This week's non-farm payroll is probably the most important jobs number since September of last year, when Powell cut, when he shouldn't have cut. But now he's going to cut probably. So that could be our event. That could be your call. That could be your siren song this year.
Do we want to touch on silver?
Yeah, in the context of gold, I'm looking at silver like it's a miner. Okay, this is how I explained it to my subscribers a couple of days ago. Silver was cheap, right? Let's go through this. Silver was cheap. Gold was getting all the glory. And then this year, silver took off 35%. And to really make you feel good about this if you're a silver person, as I am, it rallied against the backdrop of the Fed, of recession and jobs numbers dropping. So the market has been rallying not because it's, an industrial commodity. It's not. I mean, look at today. Today, silver was up between 30 and 50 cents, depending on when you're looking at it, very volatile. Copper was down. Oil was down. There's someone out there buying silver to buy silver. And so the gold chart is a breakout. The silver chart is a continuation. I'm starting to see the players rotate back and forth. What are we going to buy today, Jordan? Oh, let's buy some gold. What are we going to buy tomorrow, Jordan? Oh, let's buy some silver, And all this while, I mean, here's the key thing for your miners, people. I believe miners are undervalued relative to bullion. I just believe that's true, right? But the market believed it as well. And the market bought the miners. And that was not, the public didn't start coming until like last week. And they came in after the banks started recommending them. They came in after the banks told the miners to hedge, and they came in after the banks started buying them. Then the miners get up to a level that's reasonable. Like GDX is like just below the 2012 high. And then all of a sudden they hit a switch and they start buying gold again. I mean, it's like, didn't we have a couple of days where gold was strong and the miners were nowhere? I heard all the miners guys after having 85% returns. Oh, the gold's outperforming us. I was like, don't worry about it, man. They're all
I think it
going
was, yesterday they were saying, the miners are not showing much today. I think they were still up for the day and, gold was way up. Oh, they're not showing much for the day. It's like, guys, they've been crushing gold, for the last couple months. It's fine if they take a day off.
Yeah, I think speaking about myself here, we've become programmed because gold has been and silver have been, relatively speaking, slow moving assets. Gold is up, miners are up. Gold is down, miners down. But now you have a dynamic market with fresh money coming in. Macro discretionary comes in the commodity side. Hedge funds come in on the physical, on the ETF side. And so you have these guys taking turns. Macro discretionary has a model and it says, with miners at this price, gold's a buy. Now, that may be crazy, but that's what they do. And that's what they're doing. So those one-to-one correlations that we're so used to, miners are weak with gold up. Should we be worried? No, don't be worried. Don't be worried. It's kind of like they're taking turns now. There's a baton being handed. Silver led, then miners led, now gold leading again. It's a dynamic market. I know we're not used to it, but this is a dynamic market. It's interesting.
Yeah. So just to wrap up on silver, just my technical analysis, just very simple. We had that breakout from that rough ascending triangle pattern or sideways consolidation for 9 or 10 months. That measured upside target was $41 in the spot market. So right. we hit that. Now, if you look at, and I believe we talked about this, if you look at a monthly chart and a weekly chart, you can see around 42, 43. That's where the next resistance is, between here and $50. So once you go through that, there's nothing. And then the last thing, not to babble on here, but the last thing, Vince, that's really important is, and we'll talk about this next month, the quarterly close. 3760 is the all-time high for silver. So you look at all these charts, quarterly, monthly, weekly, etc. Really strong support of 35. So we know that's a floor, 35.
Right.
37.60, the quarterly all-time high for silver. It's at 41 or 42 bucks right now. Is it going to close at the end of the month? Is it going to close above that? Because, Professor, if we make a close 39, 40, or 41 at the end of the month, that's a damn convincing new quarterly all-time high. And that tells us we're probably going to go to 50 in the coming months. It's more likely than not at that point.
That's right. And to your point, the underinvested professionals, it'll pop on their list again. Oh, look, silver made another quarterly high. Do you have any silver? And the guy's like, no, I don't. Well, I guess I should buy some. You know, you could just see the funds go, oh, I'll take some profits in coffee and I'll start. Yeah, I think that's where we are now. I think we have a serial killer of shorts. You know, it's every month is a new reason to buy it. Oh, I had something else that was so important to say that I can't remember now. But
a 14-year high in silver.
Yeah, well, no. Oh, I know. I'm sorry. I'm not throwing water on it, but I want to throw a couple levels that I have out, and I'm not a technician, but I work with a couple other pieces. For me, just to throw a real level as a non-technician, you'll give them real levels. The market, the gold spot market I'm looking at here, not futures, below 35, 31 is a minor warning. Below 35, 34.97 is my actual number. Below 35, it negates this impulsive part of the move. And then below that, it has to go down to like 32.20 for me to even think about worrying about the longer term move. The reason I'm bringing these numbers up is because in conjunction with the news event and your 10% retracement or 15% retracement concept, whatever the news is, if there's no news, I'm a buyer at 34.97. If the news is Powell cutting 50 basis points and we zoom to 3,700 and then back down to 34.97, I ain't buying that dip because the news is out and everyone's going to be taking their money off the table. I'm just saying below 35, simply keeping it simple, with news out, I'm not a buyer. Below 35 with no news out, I am a buyer. That's where I am. I think that's the same thing. Oh, I know what I want to talk about. Silver. We talked about this a couple months ago. The measured move concept. It was like 39 to 35 and above 39. 39 and a half was my level. And above 39 and a half, I did a measured move of 42.50, which is close to yours, I think. So I did say that we were going to go above 40 pretty soon. And I said we get above 40 before gold cracks 35. And we did. That's spot. Now I think 42. Now this is my position talking. This is not expert advice here. I think 42 in silver before 36 in gold. It may take 10 years the way things are going right now. It may take 10 minutes. Who knows? But I think you're going to see this gold leading, silver leading. You're going to see that ratcheting like we just saw today. Gold led today. So that's it.
And, last thing we could cover, I think the miners, since they've been leading this move, and again, this is stepping back, not talking about day to day, but more talking about what's happened in recent weeks and recent months. And if you look at the miners, I've been posting about this, breadth indicators, they have been on fire, which is a good thing. But sometimes, as you know, you can get way too hot and you're too hot for too long. That can lead to a top. So we are at the point where I think miners, whether it's going to happen in a day or two or it takes another month or a couple of weeks, I think they're coming into an interim peak. And so I tend to think it makes sense, since they led this move, they've been leading gold, that they'll probably peak before gold. So if gold does have $300 more of upside from the breakout point, maybe miners have 150 or 200 or 225 of that move. So that's my thought for the coming weeks with respect to miners.
So if you're looking at this on a weekly or monthly, it's like if gold makes new highs and miners don't on a weekly or monthly basis, you want to be careful. That's what it sounds like you're saying. I mean, indirectly.
Yes. Well, if we're watching over the coming days, next few weeks, and suddenly, things are trending high, everything's going well, but suddenly the miners crap out for a couple of days and you see some ugly candles, like that could be a hint that, gold. So I mean, Cliff Notes version, look for miners to peak before gold.
No, that's I guess
I
what
feel
I
I feel that has an over 50% chance right now of happening.
okay. Let me just retract what I'm saying. I'm looking at it from a futures point of view. If futures go up, I want to see miners start to track them. If they don't, then it could be toppy. Conversely, if miners look crappy, don't buy futures. That's the advice you're giving me. I'm with you.
Yes. And with respect to silver and the silver stocks, they're completely different because if you look at SIL, that a couple weeks ago, that broke out of a 13-year long base, a breakout from a major base. And SILJ, the silver juniors, last week, at the end of last week, they just broke out from a 13-year long base. So that's, am I saying gold stocks are going to have this huge decline here? I mean, not necessarily, because look at where silver stocks are. And on top of that, GDX and the XAU, they just broke out against the 60/40 portfolio. They broke out of 11 or 12-year long bases. Remember, we were talking about gold against the 60/40
Forever,
for
forever.
months and months. And this March, we got that breakout, and look what happened to the market. So much more money came in. Well, I'm out here saying, oh, breadth indicators, miners are going to make an interim peak. Well, shit. The gold stocks at the end of last week broke out of a 12-year long base against the 60/40. So that tells us more money. There's still more money on the sidelines, more money in stocks and bonds that are going to start coming in to the gold stocks, which further complicates the potential short to medium term bearish viewpoint.
Right. No, that's a good point. Like you get up here, you are saying the breadth is getting bigger. The rally, the mining stocks being bought is broadening. And here you are looking at the 60/40 portfolio versus GDX, and the GDX breaks out against it. And here you are basically saying the base of all bases is broken out for GDX. And then you're saying, but the metrics are starting to look potentially toppy in the interim. Well, how about this? The interim is no longer 6 months. It's like 2 weeks. Things are happening faster now. Isn't that the way it works? I mean, when you have a good technical market, what used to take numbers are all that matter. But when it takes 6 months to do it, it feels a lot worse than 2 weeks. Maybe the interim is sideways for 2 weeks. I mean, it's just things are happening fast now. I agree.
It's very possible.
But I mean, what is an like if you're looking at like a 12-year base or 11-year base, whatever you said it was for GDX? I mean, what's a pullback? You know, a pullback that I would buy on the miners. If I'm a trader and an investor, I would be a big buyer of miners on a massive dip in gold. Right. So the story is Powell cuts 50 basis points. Gold rallies $100, and then over the next 2 weeks drops $300, and miners get pummeled as all the normies go, oh, gold sucks. And they start to get out again. They start to buy Mag 7 stocks because Powell cut 50 basis points. I'm telling you, you can see that. And then you and me will be down there just buying miners on a dip because miners are in play now. They're not hated anymore.
Well, because and what you're talking about there leads me to think, we talk about it in a very strong market. How do you correct? Well, you correct by going sideways for a while, like we just saw in gold, for
Right.
4.5 months, super bullish consolidation. Or on the other hand, you can have a sharp move down like you're talking about. Maybe, Powell cuts big time. We shoot up for a day or two after, and then we have a really sharp decline in miners over the next month. And it's like, oh, shit, I hate this. Why did I buy these? And then it just rebounds and keeps going back up. And,
Yeah.
people are just dumbfounded.
That's the wall of worry. They say a bull market climbs a wall of worry, working in our favor. The normal investors that are saying out of Mag 7 stocks into miners, they're buying miners up here. They're not buying miners where you bought them. So they're going to be puking. And the question is, how low will the big boys let it go? And I hope a lot lower at this point. But it's hard to say because I think miners have really changed their tune, maximizing shareholder value. They're responding to what the banks want. They're getting their costs down. Newmont just announced they're going to be firing people. It's funny. I mean, it's funny because Bloomberg's headline was Newmont's costs are too high. They have to fire people, so it's basically Newmont is a bad company. And then when you read the article, as I did, it's like, well, Newmont's been advised by Boston Consulting to get their cost of production down, their AISC, and they can lower it by as much as $300 by getting rid of redundancies from their recent acquisitions. And that's what you do. The funny thing is, I can't believe miners haven't done that yet, but now they're doing it. I could just hear the bank saying, do you want your stock to go up? Then fire some people, increase your dividend, buy some shares back, buy some really fat, juicy little junior to add to your balance sheet. I could just see the miners listening to the bankers' siren song for the right reason. Bankers aren't evil when it comes to miners. They just had much easier fruit to pick. And they were short miners. Don't get me wrong. They were short miners. And now they're like, okay, it's time to buy miners because they're greedy. Hey, people aren't buying AI stocks this week. What should we put them in? I don't know. Let's put them in gold. Well, gold's 3,500. Oh, screw it. Let's put them in miners. I mean, you could just see the wheels spinning at these banks doing this. So yeah, I think we're here to stay.
Okay. Anything else you want to mention with respect? Yeah.
You're on the road, so let's keep it simple.
All right. Very good. Thank you, Vince. As always, next month will be exciting. That quarterly close in silver. We'll see where it is. I mean, that could be really exciting. Maybe the Fed cutting rates. So next month will probably be more exciting.
Well, that's the thing. I mean, this isn't exciting enough for us now. It's pretty exciting. We're getting spoiled. Anyway, people can find me at VBL Gold Fix on Substack, but we'll be here next month. It'll be another quarterly close where you could say highest close ever for silver, and gold.
I'll have to have my silver hat and silver wig for that one.
You got a silver wig?
I do. I think I do.
Sci-fi silver wig. Nice. All right, cool.
All right. We'll leave it there, everybody. Gold Fix on Substack. And thank you so much, everybody, for tuning in. And leave a comment. Let us know what you think. And we'll talk to you guys again 1 month from now. Thank you.
Thank you for tuning in to the Daily Gold Podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.